Greetings, fellow seekers of investment wisdom and early adopters. I'm your host, Bob Simpson, and you are tuned into another exciting episode of My Private Network. We're absolutely thrilled to have you back with us today. Now, on today's podcast, we do more than just scratch the surface of the investment world. Each week, we swing the doors open and introduce you to some truly exceptional individuals. These are not just specialists in the investment community, they're disruptors, pioneers who have fearlessly embraced uniqueness in a world that is increasingly defined by constraints and regulations. Our ultimate goal is to empower you to achieve financial success, that which you deserve and desire for yourself and your loved ones. So stay tuned as we embark on another enlightening journey through the world of investments, innovation, and financial freedom. Welcome to My Private Network. Today's guest is Will Granleese. Will is Director and Portfolio Manager of Antrim Investments out of Vancouver. He last joined us in episode 3, Why Allocate Funds to Private Real Estate Debt, and he is the channel manager for the Concept Mortgage Investment Corporations. So Will, welcome after a long introduction. Sorry to do that to you.
Thanks very much. Happy to be here.
Yeah, welcome. And we're glad you're able to find the time to join us today. So just to take it a step back, Will, over our lives, one of the things that we all know is that we've all paid hundreds of thousands of dollars in mortgage payments, and we probably have cursed. You know, it's like being a Leaf fan. Will and I were just talking about this as we were getting started, that, you know, as living in Toronto, we always curse the Leafs when we're in the playoffs. And now he's living the life with the Vancouver Canucks, having a good season. But, you know, we tend to curse the amount of interest that we paid over our lives. It's actually pretty amazing numbers. I think it would be interesting for most people to think about, you know, aside from taxes, we spent a lot of money on interest on mortgage and that sort of thing. And as baby boomers, we all remember back in the, you know, I know 14.5% mortgage rates, and you know, every time we made a mortgage payment, very little of it really went to paying down the principal of the mortgage. So if you, our listeners, have successfully made the transition from borrower to investor, maybe it's time that we turn the table and be one of the beneficiaries of today's higher interest rates to help us generate income and build wealth. So let's see what we can do today. Start out by just introducing yourself to our audience. You know, I know that your family's been involved in the mortgage business for decades.
Yeah, we have. So Antrim Investments has been in business now for over 50 years. During that time, we haven't sort of strayed out of the mortgage space. We've strictly stuck to the mortgage space. And as you say, we're sort of bringing this new investment or this new era of investing in mortgages to the regular Canadian, people that maybe are not high net worth, maybe that have a little bit of savings and want to invest in a mortgage, but how can I? I don't have a couple $100,000. Well, with something like a mortgage investment corporation, we can take your funds and group them with other investors. And so something similar to a mutual fund, but instead of investing in stocks and bonds, we just invest in regular first and second mortgages. And it's worked very, very well.
Yeah. So business started 50 years ago. Where were you back 50 years? And what has led you to join into the family business?
Yeah, that's interesting. So growing up, of course, mortgages was all the talk of the house. But as a youngster, I can't say I was really that interested in mortgages. I liked the investing side, and I really liked stocks and bonds. And I thought I was going to be this hotshot stock trader. Well, after my undergrad degree, I joined Toronto Dominion Bank, and I became a financial advisor. And I really saw what the reality was, which was, you know, it's not every stock you pick you make money on. Some stocks win, some stocks lose. And what you're looking at is what do you average earn over a period of time. Back in the day when I was looking at those old Index charts, I said, you know, Antrim, my father's business, they do it better than the stock market. There's no volatility with Antrim, and we're earning very similar rates of return to the stock market. So after I completed my MBA, I came back to Antrim and I said, you know, Dad, we've got to tell more people about this story. We've got to let people know that other alternatives exist, right? The world is not just stocks and bonds. And so that's how it really started.
You know, and it's very similar to my own path where I started out as an advisor back in the early 80s, and interest rates, I remember the first thing that I was assigned to go out and sell. That was Canada savings bonds at 19.5%
Right.
interest. And, it was funny back then because everybody thought rates were going to 22. So they didn't want to lock in at 19, where they could have doubled their money every few years. But, what I found was the same thing. Equities were interesting,
Yep.
but many people out in the investment landscape are looking for security. They're looking for certainty. They want to use the power of compounding. And with equities where you have up 20, down 10, up 15, you kind of lose some of that compounding. So having a solution like yours, I think is really interesting. And it didn't take long for you to discover that maybe Dad was on the right path, which is a difficult thing to accept at times, isn't it?
Indeed. Yeah.
Indeed. Yeah. So really you fit into the category of private lender, right?
Mm-hmm.
So the question I think that a lot of people would ask is, who borrows from private lenders? If they need a mortgage, why don't they just go to the bank?
Well, the interesting thing is, when I used to think about private lenders, I thought, people aren't approved at the banks, so those must be sort of less secure loans. And it's not the case at all. The people who actually borrow from private lenders are high net worth individuals looking for solutions-based lending. So high net worth individuals, what does that mean? Well, in order to get a loan from someone like Antrim, you need to have at least a 25% deposit. So for any young person that's just graduated university and they're buying their new house, very, very few of those type of people have 25% down payment. We're typically dealing with people that have been successful in business, sort of between the ages of 45 and 65 years old. They're now wanting to buy something. They've gone to the bank because they've seen their dream house is up for sale down the street. And the bank says, well, yes, it's a very lovely property, but I am looking at your notice of assessment or your most recent pay stub, and it doesn't look like you can afford to buy this. And they say, well, what are you talking about? I made $200,000 last year. Well, you might have, but you wrote off your car expense. You wrote off meals and entertainment and everything. And because they're self-employed, they can't prove that they can actually make the mortgage payment. Now, this was not such a big deal 20, 25 years ago, but after the financial crisis, when the government went in and looked at the banks and said, listen, we've got to make sure that we don't have any more bank failures or mortgage failures in particular, they made income confirmation sort of their top priority. So if you can't literally prove that today 5-year mortgage rate is 5.5% plus the 2% stress test, if you can't qualify for that, then you just can't get the loan. So people we lend to, great credit, they just have some income confirmation issues on their loan.
Kind of makes me think that somebody has a conversation with their accountant and their accountant says, now there's two ways. One is we can make it that you pay very little tax, but you're going to have trouble getting a loan at the best rates. Which way do you want to go? Right? So these aren't deadbeats that you're lending to. These are people who are well off, they can do it. They can make these payments. It's just that they can't show to the bank that they pass all the tests.
I would argue that 75% of our borrowers don't only own one property, but own multiple properties. And they might be buying another property, they might be buying a revenue property, and the bank says, you know what, we just can't see that you make enough money to be able to afford all of these properties. That's what we see.
Yeah. What happens if one of your tenants moves out? Now you're in trouble. And then if you're in trouble, we're in trouble. So, you talked about 25% down. One of the things that I know we've talked a lot over the past few years, but you're very disciplined in your lending, aren't you? What does a typical mortgage in your portfolio look like?
So I think what differentiates Antrim from the rest of the mortgage investment corporations is that we only focus on residential properties. We don't even do construction mortgages, right? It's no commercial, no construction, no industrial. But how we also restrict ourselves is we only lend in major centers. So British Columbia, Alberta, and Ontario, we only lend in major centers, nothing outside of town. And that's just because what we found in the past is that we might lend quite conservatively on a property that's way outside of town. But when a recession hits, you're dealing with a lot fewer buyers, and you might have no one out there that's willing to actually buy the property. So what we found is that our shareholders are looking for a good rate of return with excellent levels of security. So they're willing to take a slightly lower rate of return, but know that they're investing in what everybody wants, which is typically a detached house in a suburban location in a major center of Canada.
Mhm. Yeah. It really comes down to if you have a house and you're in, a small town, there may only be a couple of buyers and, you're not in the business of owning the homes. And
Right.
you do have in your portfolio, your portfolio is quite broad. Always think of you in the 2,000 plus mortgage range, right? Where are you now? What's your latest number?
We have got about 2,400 mortgages on individual properties.
Yeah, that's kind of flattened out over the last couple of years. I remember you were growing
Yeah.
that more quickly, but yeah, 2,400 is probably a good number.
Yeah.
Yeah, so it's broadly diversified, but within those 2,400, you do have some mortgages that don't work out and that you have to take action on.
We do. Absolutely. Yeah. So I think the percentage of mortgages right now that we might have issues with would be maybe around 1.5%. So for people, for whatever reason, maybe they spent too much at Christmas, or their car broke down, or whatever, many reasons, they didn't make their last mortgage payment. But those people typically make up their payment within the next 30 days. There's very, very few people that we actually have to foreclose on, extremely few. So of those 2,400 mortgages, I think we've got about 3 files that we're currently foreclosing on right now. So that's and no lender wants to foreclose on anyone.
No, you don't.
No one wants to go through that. So yeah, we're very happy that the market is so strong, that the belief in residential real estate is rock solid.
Yeah, and even within your portfolio, I think you've told me before that from time to time, you will work with your borrowers. If they go through a bit of a rough patch, that you're not going to nail them up against the wall and say, these are the rules like a bank would. You're
right.
You tend to be a bit more flexible. Is that still the case?
Very, very fair to say. You see, if a person stops making their mortgage payment with Antrim and we take the file to court, the judge will look at the file and say, okay, so this house is, let's say, worth $1 million, and Antrim, your loan is 600,000. There's no chance that you're going to lose any money on this. So the judge will typically give the borrower ample amount of time to sort themselves out one way or another. So yes, we work with our borrowers should they have any issues. But of course, we have rules in place as well that we have to proceed with our security. But in general, dealing with a private lender, you should have more lenience, I would argue, than dealing with the bank, in which case you miss that first payment with the bank. The bank might have a loan. It might be secured by CMHC, the Canada Mortgage and Housing Corporation, in which case CMHC says if they've missed the payment within 30 days, you've got to start that action. But they're dealing with people that have maybe only put down 5% down payment, whereas we're dealing with people that have put down, on average, let's say 40%.
Yep. There are very few homeowners who are going to walk away from 40% equity in a property. That just makes sense. Now, we're talking about the numbers, just to talk technical for a sec. There's a phrase, loan to value. Can you just talk about loan to value and kind of your metrics around that? And I think you've already talked much about it, but yeah, just spend a second talk about loan to value.
So when we talk about loan to value, what we're referring to is the percentage of the house's value our loan represents. So for a 75% loan to value, the loan would represent 75% of the home's value, and the borrower would come up with the additional 25%. So we're allowed to lend up to 75% of the value of any particular mortgage loan that we have, but we find our borrowers typically don't require that large a loan. And the weighted average loan to value on our portfolio at Antrim is only 58% as of today. So if you can believe it, it means that the average loan we have at Antrim has a borrower with over 40% down payment. This is why Over the past 30 years of us managing mortgage investment corporations, we've never had a single year of negative rate of return. We've averaged over 8% during those 30 years, and our share price has never changed.
Yeah. And, I would assume that if you have lots of collateral, that your return should be fairly stable.
Yeah.
Yeah. So talk about secured lending as opposed to unsecured lending. We're reading reports that banks are having major write-offs right now. Can you address those couple of items?
Yeah, well, I mean, the concept of secured lending is very simple. We lend someone some money and they provide us security of something. In our particular case, they provide us the security of a mortgage on their real estate. That's a very, very different product than just writing someone a check and hoping, fingers crossed, because they paid everyone else back in the past, that they'll pay you back. Generally, with unsecured lending, so there is no security, the loan amounts are quite small. So you might be able to borrow, let's say, up to $30,000, $35,000 on an unsecured basis. But when you go beyond that, the banks that typically offer that are going to be looking for some kind of security. And typically, it's going to be either a car or a house in our particular case.
Yeah. So something that they can send the tow truck in, grab it, carry it to another spot, sell it to somebody else, get their money back.
Now, your second point, which I didn't refer to, was saying, I hear the banks are increasing their write-offs or their loan loss reserves. Yes, they are. However, if you actually dive into the numbers, you notice that the banks are expecting to take much higher losses on Visa cards, MasterCard, on unsecured lines of credit, on car loans. I think Bank of Montreal just said, we don't want any more part of this. And they've actually left the car loan industry.
Oh, is that right?
Yeah, absolutely. So but if you actually take a look at the mortgage amount, so the amount of delinquency or the amount of NSF payments on the mortgage, it's literally at a historic low among the major banks. And that even goes with the increasing interest rates, because the banks now, with this mortgage charter that the federal government has introduced, the banks are able to work with their borrowers to extend the amortization period, i.e., to extend the amount of time it takes people to pay off the loan, so that they can actually afford these rates in our new rate environment.
Yeah, and we're also seeing, I went on a tour in the US and, with a company that does housing developments. And what they're saying is that the builders are writing down the mortgages so that, hey, we'll give you a 5% mortgage on this for the next 3 years. That should get you, that should get us through this period of high interest rates. And then you should be back onto something normal.
Well, I just one point I would add is that we're not in a high interest rate environment. I mean, initially, to start this whole presentation, you talked about the 1980s with 19.5%. That historically is a high interest rate environment. But a mortgage rate starting with a 5% is not high at all. It is very normal. When I started writing mortgages at TD Bank in the late 90s, I was doing 5-year mortgage rates at 5%. That's what the rate was. So what we're just doing is we're coming out of an extremely artificially low interest rate environment into something that's more normal. Mm-hmm. And yes, it's stressful for some borrowers, but we need to get a more normalized marketplace.
Yeah, I always find it funny when people talk about us being in a high interest rate environment. Yeah. Compared to where we were.
That's right.
Where you could have bought a strip bond that yielded 22% in your RSP for 30 years, which would have been a good investment, right?
Wow.
Yeah, that was crazy times back then. Now, whenever we talk about private lending, one of the things that everybody talks about is liquidity. And I am speaking at a conference beginning of March, the same one that you and I attended a couple of years ago when the Leafs were in the playoffs, briefly in the playoffs. But liquidity is usually a problem on the private side. Private lending often has periods of, minimum holding periods. They have early redemption penalties. In your case, how are you different?
Well, we're different because we offer liquidity on a best efforts basis of T+2, which means 2 days after you request your redemption, you've got your funds. And how are we able to do that? Well, we have a line of credit that is syndicated by Toronto Dominion Bank and the Royal Bank of Canada. So we have a line of credit that we dip into with our redemption requests. But more importantly than that, it's the product that we have in our pool. And what we have is 2,400 individual residential loans. And do those people want to continue to pay Antrim, let's say 9%, when they can go to the bank and they can pay 5%? No, they don't, right? They want to pay us off. And so what we find is with our loans, the average loan stays with Antrim for about 2.25 years. That's about it. So we have about 35 to 40% of our portfolio paying us off on a daily basis. And so we use those funds for any redemption requests that come in. And the liquidity for us has never been an issue. There's never been a time where we've had to tell people, sorry, we can't redeem at this point in time. However, currently, right now in Canada, there are a few mortgage investment corporations that have a different line of business. They might lend on commercial properties. They might do very large loans, $100 million loans. And some of those loans on development properties, well, the development right now is not going according to plan. Or they might have lent on an office space that, it's taking longer for people to come back to the office.
Yep.
And on those particular properties, you can run into liquidity issues, in which case, if you ask for your funds back, the fund might say, hey, you know what? We just can't do that right now because your funds are invested in this project. As soon as this project is complete, then we'll go ahead and do that. But because Antrim doesn't look into any of those types of loans, we tend not to have that.
Right. So your typical mortgage is a 1-year mortgage.
1 year. Every mortgage we do is a 1-year term. Yeah.
1-year term. Yep. And so 1/12 every month?
You know what's interesting is that the mortgage market is cyclical. So we tend to have a little bit more mortgages in the spring and in the fall. But yes, every month we've got $30 or $40 million worth of mortgages paying us off that we have to find a new home for.
Yeah, you have to find a new home. Yeah. So you've talked about, your share price has limited volatility. Have you had, over the last 30 years, how many negative months?
Never. We've never not paid a dividend. We've never had a negative month. And when people buy Antrim, they look at it, and I'm not saying we're a guaranteed investment, but when you look at Antrim over the long term, it's sort of this very smooth graph going up. And that's because we don't have what's called NAV volatility, or net asset value volatility, which means our share price is constant. It stays the same every day. When we pay a dividend, we just pay you more shares. It's not as if our value increases. And how do we do that? Well, we do that because Antrim is actually created out of the Income Tax Act. So don't hold me to this, but I think 1972 or 71, the Income Tax Act was adjusted to create mortgage investment corporations. And mortgage investment corporations were designed to help influence or provide more capital to the home building, residential home building construction industry. And we were set up as what's called a flow-through investment. So there was no retained earnings in Antrim. We make interest by lending to people. So we earn all this interest, and then we have to flow through all of that interest to our shareholders annually. So because we don't have any retained earnings, there's no way for the value to go up and down. You might say, oh, well, Will, what about when interest rates go up and interest rates go down? Doesn't that affect the value of the underlying investment, which is mortgages? And yes, it does. However, we reset our interest rates on an annualized basis. So the duration or the average length of any mortgage in Antrim is really only 7 months. So interest rates can move around, and it doesn't really change the value of the portfolio itself.
Yeah, so it's easy enough to do. So we've talked about volatility. Let's talk about returns. For investors purchasing your fund today, what would the current return be? How does that compare to what the returns would have been over the last couple of years?
We've already talked about it during this podcast. It's the rate of return is increasing on a daily basis because interest rates are increasing, and we're taking the older mortgages that we had at Antrim that were set at older rates a year ago, and we're renewing them into the current rate environment. So our expectation for the next 12 months is to be paying out approximately 8% over the next year. And then over the next year, we'll have everyone renewed into this current interest rate environment. And so the following year, we're predicting a 9% rate of return. And I would argue that we'll probably sit there for a couple of years, and then we'll probably fall, I don't know, maybe 0.5%. We'll see what actually happens in the mortgage interest rate market. But that's what we're predicting over the next couple of years.
Right. But your crystal ball is in the shop, right? So
Exactly.
yeah, it's difficult to predict.
It is.
So, kind of in conclusion, if we look at things that, if we compare your returns to some of the other private lending that have less liquidity, they have more penalties on early redemption, that sort of thing, your rate's a little bit lower, but it's in the ballpark, but it comes with much better liquidity and probably lower volatility, lower risk of having your fund locked up.
I mean, I'm sure many people watching this podcast will either have invested in mortgages privately themselves or will have known someone that's done it in the past.
Yep.
And I'm sure they're saying,
do that, right?
Yeah.
Don't do that.
8 or 9%. Oh, I know Johnny is getting 14%. Well, he probably is. But guess what he's investing in? It's a construction project that's an hour out of Toronto, and it carries with it a tremendous amount of risk. And not only that, there's no liquidity because he's got to wait until this one project completes, and then he gets all his funds back. So there is, to my knowledge, I am aware of, say, 10 or 20 of the largest mortgage investment corporations in Canada. There is no mortgage investment corporation that provides the T+2 liquidity that we have with the size of our fund, with the liquidity that we present and our interest rate. Yes, you can earn more, but you're taking on a lot more risk than you are with Antrim.
Yeah. No, the returns can be better, but it's all related to the liquidity and the risk of that.
Exactly.
So Will, do you have any final thoughts before we close things up today?
I don't. I think you've done a good job of asking all these diligent questions.
We try our best. So Will, thanks for joining us today. I always enjoy our conversations. You bring great insight, and thanks for being here.
Anytime, Bob. Always appreciate answering any questions and teaching more people about the mortgage market.
Yeah, and that's really what we're here to achieve. Is we're here to educate. We're not here to push products. If it's right for you and you understand the investment, then we've helped you to move in the right direction. Now, this podcast will be available on privatedebtandequity.ca as educational content for mortgage corporations, for the concept mortgage investment corporations. Before making any investment decisions, it's crucial to consult a professional financial advisor to determine suitability. Full disclaimers are available on privatedebtandequity.ca. Now, also don't forget to subscribe to our YouTube channel to stay updated on new episodes. So in closing, I'm Bob Simpson. It has been my pleasure to guide you through this enlightening conversation with Will. Please remember, knowledge empowers you to make informed investment decisions and progress towards your financial objectives. Until we meet again, stay focused and disciplined on your financial journey. Thanks for joining us today.